Good Wednesday afternoon to you. Welcome to the Jon Sanchez Show on News Talk 780 KOH. It's a pleasure to be with you on this snowy, cold Wednesday afternoon. My goodness. I don't know about you, but trying to stay warm out there. That's all we can do. The wife is going to be putting some chili beans on the stove this afternoon. I do think that is the menu request by all means. Well, I hope you had a great hump day today. And what a show I have lined up for you today. After I go through my stock market recap with you, I want to share with you what I'm going to be covering. You know, most retirement plans don't fail because of bad markets. They fail in the first 5 years because there's no income plan. That's right. You heard me correctly. There's no income plan. And that, folks, is one of the biggest issues that we deal with. Today, we're going to be breaking down what I call the retirement income gap. Now, what do I mean by that? The retirement income gap means why having money isn't the same as having a paycheck, meaning a portfolio paycheck. I'm going to be going over what you can do right now to make sure that your retirement lasts as long as you do. Now, you've heard me say this many times over the years, that it's not the size of your portfolio that really matters. What does matter, however, is what is that portfolio doing for you when it comes to your retirement income, right? That's the reason you're saving all this money. Sure, you're going to take some periodic withdrawals here and there to buy this or buy that, etc. But really what you're doing when you're saving in your 401k, when you're saving in your IRA and all these other things, essentially what you're doing is you're going, hey, you know what? I need to produce some income off of this thing at some point. I mean, right? That is the main reason that you're doing what you're doing. And so what a lot of people don't realize, they think, oh, I've got, whatever, pick a number, $1 million saved up. $500,000, $2 million, whatever the number is. They think, oh my gosh, it's going to be a phenomenal retirement, right? I'm going to be able to do whatever I want to do, whenever I want to do it. I can spend like a drunken sailor. It doesn't matter. But that is so far from the truth. Because if that portfolio is not aligned correctly, if it's not actively managed, if it's not diversified, and you suffer some major stock market declines, remember these time periods, folks? It's been a long time, year after year after year, where the market just doesn't do anything. Your portfolio doesn't do anything. Matter of fact, it's going down. Your portfolio can sit flat. But let's say you got $1 million portfolio, and all of a sudden, we go through a 10% market decline. Well, now you have a $900,000 portfolio. And what may have started as a, 6% withdrawal rate on $1 million, right? That was $60,000. Now, if you continue to do that, a 6% withdrawal rate on only $1,000 portfolio, that percentage now jumps up dramatically. So before you know it, you're doing a 10% withdrawal rate a year, 10, 12, 15. I've seen it all. I've seen, matter of fact, folks, as high as 25% withdrawal rate. Then you may be thinking to yourself, wait a minute here. How can someone take 15, 20, 25% withdrawal rate from the portfolio? Well, they can't. But here's what happens. I'll give you the real life example. I think I've shared this story before and I want to do it again. So this was relatively early in my career when I was with, I think I was with Smith Barney at that point. I think we'd already gone out of the Shearson Lehman Brothers mergers and things. And I was in Bakersfield, as I said. And what had happened was, this was the era, and I want to say this was 98, 99, right around there. Right when, of course, the dot-com era was booming. And so what we saw was a lot of people taking early retirements. And one area in particular, at least it was in Bakersfield, that had a huge, massive early retirement, golden parachute type of package were the telecom companies. Remember the old GTEs and Pacific Bells and all those? Well, there was a lot of those employees in the Bakersfield area. And what I saw happen was a lot of financial advisors they were just doing seminars after seminar trying to get these people that were going to retire to roll over their money to them, right? And there was one advisor in town that I couldn't figure out for the life of me how this woman was getting all of the business. I mean, she was a small independent, not that that has anything to do with it. But it was like, I remember I got one Pac Bell client and he goes, yeah, we had this, I won't say what her name is. She came in and put on a seminar for us and the whole room basically decided to go over with her. I'm like, what in the world? I mean, I just didn't get it. So I started doing a little bit of checking. Well, what this woman was doing was she was doing these rollover retirement seminars. She was promising these people around a 12% withdrawal rate. And she was promising because of the onslaught of the dot-com era, right? 12% was nothing in those years, right? The markets were doing phenomenal, double, sometimes triple those amounts. But what she wasn't telling people was, hey, you can take 12% out of your account and not even going to touch the principal as far as retirement income. You're not going to have any retirement income gap. But guess what? What she wasn't telling them, and what she didn't, most importantly, prepare them for, was when those times weren't so good, right? Our job is to be the dark cloud. We have to look and see what happens, stress test the portfolios, as I'll touch on in a little while, and plan for those days when they're not so bright, when they're a little bit dark, some dark clouds, a little bit of gloominess going on. And so she was promising these very, very high rates of return. I mean, literally, as I was told, and the courts also found the same thing, she was guaranteeing to these retirees that your portfolio was going to grow 12, 15%. Crazy numbers, crazy, crazy numbers. So all these people left, the telecom companies very early. They retired thinking, my God, life is great. I've got my $500,000 401k plan. And, she's telling me I can take 20% out. My gosh, I can take 100,000 out. That's double of what I was making on my job. Life is going to be great. Well, lo and behold, what happened? Dot-com bubble burst a few years later. What started off as a 20% withdrawal rate now turned into, oh gosh, I think I saw as high as almost 45% withdrawal rate per year that these new retirees were taking. When that happens, folks, there's no way you can ever recover. That means your portfolio, if you're doing a 45% withdrawal rate, it's just some crazy number, right? If you're doing a 45% withdrawal rate, and then markets are dropping 10, 15, 20% as they were in that era when the bubble burst, you never can recover. A lot of people don't realize this, so I want to throw this point out there as I'll get into in the topic. If you're doing let's just say a 6% withdrawal rate, and your portfolio declines 10%, I always test people on this. I say, if your portfolio drops 10%, how much do you need to make to get back to that 10% loss? And they go, well, I got to make 10%. No, you don't. Running the math, about 11 to 12%, depending upon different time periods and things like that. But if you suffer a major portfolio drawdown, I guess is a better term, you've got to make not only that drawdown, 10, 15%, but you have to make more than that. And realistically, how long can that sustain? Not very long. So lo and behold, to go back to that advisor, she ended up, once all these retirees ran out of money, or they, went from 1,500,000, whatever number they started with, and it was down to significantly smaller numbers. I remember seeing one portfolio that started at 500,000, and by the time I think it was about 3 years went by, it was down to about 100,000. And these people started talking among themselves, right? That's one thing about retirees. They'll go to lunch with each other and they'll chat. Hey, how's your portfolio doing? Oh, man, I went with, XYZ advisor and things were great in the beginning. That now, my $500,000 portfolio is down to 100,000. Like, yeah, me too. Same thing happened to me. And all of a sudden they start talking among each other. And one of them goes, hey, you know what? We ought to get an attorney involved. And that's what they did. They got an attorney involved, and lo and behold, they filed a class action lawsuit against this advisor for what she had promised them, guaranteed them. And last time I checked on her, she was in federal prison for what she did to these people. So that's why my moral to this whole story is, when it comes to the retirement income scenario, it's not the amount of money that you have, but it's what those investments are producing for you. And again, what they can sustain on a regular basis, good markets, bad markets, periodic withdrawals, that type of thing. So it's a very, very fascinating subject. And again, one that's very important if you are near, or even if you are in retirement, right? Things are good in the market right now. But once again, I got to be the dark cloud for you, unfortunately. I got to say, okay, what happens if? Have you stress test your portfolio? How much can it drop before you have to cut that 4, 5, 6, maybe 10% withdrawal rate you're taking now down to a realistic number? And what is that realistic number, as I'll share with you? But right around 4 to 6%, depending upon the allocation, the risk of the client, so on and so forth. Are they going to take periodic withdrawals? So we typically range our clients between 4 to 6%. That's our comfort level because of the way that we allocate the portfolios, that we actively manage them, so on and so forth. Some advisors are higher, some advisors are lower, and it really changes based upon market and economic conditions. When we get into bad market conditions, you'll see kind of the industry norm come back and go, oh, you need to be doing 2 or 3% withdrawal rate. When things are good, oh yeah, 5, 6, 10, whatever. Seen it all. So, once again, what we're going to be focusing on the retirement income gap, why most plans fail in the first 5 years. So, when I come back, I'm going to tell you what this market did today. Good session today. Glad to say that for a change. Then we'll get into some of the movers and shakers. And then, bottom of the hour, we'll get right into our topic, why this is so very important for you if you're in or near retirement, or maybe it's down the road 5 years. I'd rather you find out about it now and be able to plan accordingly than get surprised by it. Let's turn it over to Kristen Snow. She's in the Right Now Traffic Center. Hello, Kristen. Back at the Jon Sanchez Show on Newstalk 780 KOH. Happy Wednesday to all of you. A snowy Wednesday. Please be careful. All right, we're going to get to our topic here momentarily, the retirement income gap, why most plans fail in 5 years. But first, let me bring you up to date on what happened on Wall Street today. Pretty solid session, as I indicated. We finished with a gain of 129 on the Dow. That was a 0.26% gain to close at 49,662. NASDAQ, 175-point rise, 0.78%, closing at 22,753. And the S&P for the day was up 38 points, a 0.56% rise to 6,881. All right, on the commodity side, we gained $2.66 on oil, $64.99 a barrel. Good day for gold. We needed it. We've kind of been getting beaten up here these last few days. $103.30 rise, $5,009.40 was our closing price. And over to the bond market, 10-year Treasury finished up 3 basis points to yield of 4.08%. All right, now let's get to some of the big movers that went on. So first of all, let's go over the economic side of things. It was a pretty busy day on the calendar. Most importantly, we had the Fed interest rate decision. I'm not going to bore you with it. Bottom line is same old stuff. I mean, it's might as well do copy and paste because that's all we're hearing from the Fed anymore. I think before Powell steps aside, they basically said the same thing. They're going to continue to watch inflation and they'll make their interest rate decisions based on that. Street's takeaway was it's still basically on the same path, which is the first cut coming in June. No one came out today and said, based upon the minutes, we've reduced our outlook from 2 cuts this year to 3 or anything like that. As I said on the show yesterday, the street right now is predicting 3 interest rate cuts in 2026, the first one coming in June. But that wasn't just it. We had mortgage applications came in. Mortgage applications rose 2.8% last week. Prior week, it was down 0.3. So again, these lower interest rates are definitely spurring buyers coming in and refinance and so on and so forth. And that's exactly what the boys said on the show yesterday. December housing starts came in at 1.404 million. Prior was 1,322,000. So that was a good number. And again, this was December, so factor that in. Building permits came in at 1,448,000. Prior was 1,388,000. So both of those, the building permits and of course the housing starts, coming in much better than where they were before. Then we go move over to the factory floor. We had durable goods. These are your big ticket items that have a life expectancy greater than 3 years. Washing machines, automobiles, airplanes are all thrown into that durable goods mix. And it was a good number. Durable goods for, again, old data, December rose 0.7%. Prior was revised up to 0.2%. Capacity utilization, in other words, how effective are these factories in producing things? And how much of the floor are they utilizing? That number rose also 76.2. Prior was revised to 75.7 from the previous 76.3. So you always like to see it around that 75% plus. So that was a good number there. Like I said, we had the Fed interest rate meeting or minutes from that January 2028 meeting. Nothing really came about that. Market dipped a little bit on that news, but again, it was nothing real significant. So like I said, pretty quiet day overall. I do want to mention this though. We've been talking a lot on this program. If you missed any of our shows, please pick up our podcast, find us on YouTube, so on and so forth. We've talked a lot over the last few weeks about the rotation, right? This rotation that's been going on in the market, specifically out of software names for all the various reasons, overvaluation, et cetera, that they've been talking about. Well, as I basically warned everybody, be careful dumping all your software stocks and all that, because it's the whack-a-mole game, right? One day, 1 week, they love software. The next day, next week, they hate it. And it's like the whack-a-mole game. They pop, one head pops up and then they hit it and another one pops up somewhere else. And we finally saw that today. They finally came back in and started buying the software names, which is very important. That's why we saw some pretty good strength in the NASDAQ today. Cadence Design up $21.55, 7.6% gain to 305.01. That was the massive gain on that stock. They got an upgrade at Rosenblatt to a buy rating from a neutral. Apple Oven, which has been beat up, $28 and a penny rise, 7.44% to 404.39. Mr. Softy up $2.74, 0.69% to close at $399.60. NVIDIA, another strong day, $3 and a penny rise, 1.63% at $187.98. Micron Technology, 5.3% gain, up $21.17 to $420.95. Garmin, boy, you don't hear much about them. I'm a huge believer of their products. Love their products. Great earnings number. One of the top performers in the S&P 500 today, gaining 9.2% after a strong earnings report, $19.97 rise to 236.95. GM up 8.5%, $2.90 gain to 37.17. And Caesars was another strong performer in the casino space, gaming space. 0.03% gain up $2.47 after a very strong earnings release. And I'll wrap it up with global payments, 16.46% gain up $11.48 to 81.25. So there's some names that are moving around. Where do we set year to date? How about the Dow's up 3.3%? S&P's up just a half. NASDAQ still underwater, down 2.1%. And the Russell 2000, a solid 7.1% gain. All right, with that said, let us begin our topic, getting into, once again, the retirement income gap, why most plans fail in the first 5 years. All right, so what do we want to start off with? Well, I like to call this the big mistake, right? The big mistake that a lot of people make. And I gave you my story earlier. Most people retire with a portfolio that they think is going to last them for many, many years. Matter of fact, their lifetime, right? If you ask anybody, they're like, oh, this should be enough money to last me a lifetime. And of course, what used to be, oh, I want to retire with $1 million. Now it's like, I need a couple million if you look at some of the projections out there. Again, I don't fall for that. Don't fall for that. What you need to fall for is how much income can my portfolio provide for me on a sustainable basis? Good markets, bad markets, good economies, bad economies. It doesn't matter. I don't care if it's a $300,000 portfolio, $30,000 portfolio, or a multi-million-dollar portfolio. How can that money sustain you? What are your income sources? So when people start thinking about retirement, that's all they focus on is the size of the portfolio. I need X amount of dollars. But again, what they're missing is they don't need X amount of dollars. What they need is an income strategy. So I want you to start changing your thinking if you're in this camp. Again, if retirement's on the horizon or you're in retirement, this is where you need to change your thinking. You need to go from what I call accumulation thinking to distribution thinking, right? Because frankly, when you are in retirement, you're not accumulating anymore. You're living off of the gains of your portfolio. Hopefully there's gains. You're living off the dividends. You're living off interest. You're living off annuity payments. Whatever your diversification is, you're living off of that. The goal is, of course, not to get into the principal value, right? If you have an all equity portfolio and your goal is, I want to take out 6% a year, well, obviously the math is very simple. Your portfolio better make 6% or you're going to go negative, right? That's that story I gave you earlier. Very easy to say, yeah, I'm going to take out 6, 10, 12% when things are good. But what about when things are bad, when those markets go down on a sustainable basis? We haven't had that in a while. So when I come back, I want to start off with my next point, which is why the first 5 years of your retirement, why they matter the very most out of any years in your retirement. I'll come back with that point. Let's turn it over to Jack Saban. He's got news, traffic, and weather. Hello, Jack. Welcome back to the Jon Sanchez Show on News Talk 780 KOH. Pleasure to be with you this snowy Wednesday afternoon. All right, once again, we finished with a gain of 129 on the Dow. The NASDAQ rose 175. The S&P higher by 38. All right, good day today. But do we always have good days? Well, of course we don't. And that's why we're talking about what we're talking about. For those of you within 5 years of retirement or in retirement, the retirement income gap, why most plans fail in the first 5 years. We're going to make sure that that does not happen to you. I'm going to do my best. Okay, so let's go back to, once again, why the first 5 years matter the most. Out of all your retirement, this is the most important time period. And I touched on it in a real life story at the beginning of the show. I told you about that advisor that when I was young in my career that promised clients who were retirees out of the telecom industry returns that were just out of this world. And she got all the business, and then now she's in federal prison for what she did. Because here's what happened. I'm going to give you a real fancy Wall Street term, and it's called the sequence of return risk. And what I explained to you, where she promised 12, 13, 15 higher percent return when these people first retired, right at the peak of the dot-com era, that's the real life example of a sequence of returns. I want to share with you some numbers that I came across when it comes to this, just to show the importance of it. And so a lot of times also, and I hate to say this because I hate saying the word luck when it comes to investing, but sometimes luck has to be on your side. It depends upon when you retire, right? If you retire in a bull market, where for the next few years, 2 years, 3 years, 4 years, 5 years, the market's going up and your portfolio is going up, you're probably in pretty good shape that this money is going to last you a long period of time. But unlike those people that had a double whammy, they were taking out way too much money based upon the portfolio, and they had bad luck. The market again tanked on them within a year of them retiring. So I ran some numbers for you. And I want to share this with you. It's very fascinating regarding the sequence of risk. So let's say that we have a portfolio that we're starting with $1 million. Okay. And what we're going to do is we're going to follow the S&P 500's return, historic returns each and every year. And we're taking $50,000 out. So that's not bad, right? Start with $1 million, take 50,000 out. That's only for what, 5%? That's doable. That is, unless the sequence of returns get to you. So let's go to the time period of 1989, right? So we're a couple years past the big crash of October of 87. So you retire in 1989. S&P had a total return that year of, I'm just going to round these numbers up, so I don't have time to go through the decimals, roughly 32% that year. You're $1 million at the end of the year, even after your $50,000 withdrawal. So these portfolio values I'm going to give you, this is even after your $50,000 withdrawal. That million turned into $1,266,900. Next year was a little sloppy. 1990, S&P lost about 3%. Next year was outstanding. S&P was up 30%. And we continue on until literally the portfolio peaks at, let me look at my spreadsheet here, at about, let's see, about 19, right at 2000. No, excuse me, 99. There we go. So this ties right into those people. 5,100,416. That's what that $1 million portfolio would have been worth, taking out 50,000 a year, just following the S&P 500 returns. So the million turned into 5.1 million. You're like, oh, I've got this thing licked. Man, I've made $4 million on my portfolio. I'm only taking out, $50,000. Life is great, right? That's what everybody would think. But here's the sequence of risk. 2000, S&P loses 9%. 2001, the S&P loses almost 12%. And S&P's down 32%. Next few years, it rises. Then comes 2008, 37% loss in the S&P, and so on and so forth. I'll save you the pain. From 1989, where we peaked at 5.1 million in 99, taking out 50,000 a year, 3% inflation we're factoring in. Let's see what year do I want to get to. In 2001, we were pretty much out of money at that point. We were down. We were down substantially. And you see what happens? This is the sequence of returns. This is why, again, I'm sorry, not 2001, by about 2018, we're just about out of money. Because we were taking money out. And imagine if you were taking, again, something normal, like a lot of people do, 10, 12%. You had gone, uh-oh. Because again, you got withdrawals and then you have the market decline. And this is what, again, everybody fails to realize and remember is we can go through periods where this market goes down 2, 3, 4, 5 years at a time. Many of you may not know this, but from 2000 to 2010, if we measure the performance of the S&P 500, add up all the gains, subtract the losses, S&P didn't even gain 1%. But imagine if you were taking 5% out, or what 5% maybe turned into 8% because of prior withdrawal or prior market losses. Now you're in real trouble. So you see, there's a little bit of luck as to when you retire, but there's also the sequence of risk. So the key is, especially in those first 5 years, do not take out more than, again, I can't give you a hard number, but all I can tell you is what we do, somewhere between 4 to 6%, depending upon the client's risk. And again, the allocation that we create and so on and so forth. That's that for us. I'm not telling you what to do, but for us, that's been a good, comfortable number throughout my career. Let's go to our third point, the retirement income gap. What is the retirement income gap? Well, you hear us talk a lot about risk. That was the program I created years ago. That is a cash flow program. We have the client put in all of their fixed income, all of their fixed liabilities. Then we subtract the two. We have them put in all their variable income and all their variable expenses, and we subtract those two. Because there is a distinct difference between a fixed income and a fixed liability and a variable income and variable liability. Fixed income are things like Social Security, annuitization payments, pensions, those type of things, right? Those are coming in hopefully like clockwork. They never stop. Variable income, that's the portfolio income we've been talking about. And so we want to know how much do we have coming in every month fixed versus what we have going out every month fixed, like a mortgage payment, a car payment, those type of things. In a perfect world, we have enough fixed income coming in to not only cover our fixed expenses, but also to cover our variable expenses. Now, I'll tell you, after writing hundreds of these plans, I could probably count on one hand how many people, when they come to us, have that fixed income covering fixed expenses and variable expenses. Rarely does that happen. So, but what we like to do is we like to know, again, fixed income versus fixed expenses. Hey, worst case scenario, if we have enough fixed income coming in through pensions, annuitization payments, Social Security, that type of thing, at least we know that the basics of life are taken care of, right? We can make our car payment if we have one. We can make our house payment if we haven't, those type of things. The variable side, you know what? Sometimes times get tough. Maybe you can't go spend $1,000 a month on groceries. Maybe you have to cut it back to 600 or those type of things. So that's why we break this down into our risk program. And again, if you want one, just go to our website and you can request the program, and it's free, and fill it out and see where you are in your retirement income gap. But once again, it's the difference between monthly expenses and reliable income. I can't stress this enough. Please do not make the mistake that a lot of advisors will tell you to do, which is lump it all together. Put all your fixed income, all your variable income, less all your fixed expenses, less your variable expenses. They're completely different animals, completely different. You have to break them up separately. So we like to do this, again, as far ahead of time before our clients retire. Why do we want to know that? In case we have to make any changes. Plus, it tells us also what kind of allocation we need to make. Right? If a client's just got tons of fixed income coming in, we can tend to be, if they agree, be a little bit more aggressive on the allocation. But like most people, as I said, when we run those numbers and the fixed income's not enough to cover their fixed expenses or their variable expenses, okay, now we got to really shuffle the allocation around to make sure that we have income reliable coming in, good markets, bad markets, good economies, bad economies. Let's go to our fourth point, the paycheck replacement. Again, it's not about portfolio size. Retirement success is about consistency. It's not about the growth. And that's one of the biggest challenges I have with people that are newly retired, trying to convince them, look, you got to change your mindset, right? You've been conditioned from probably your first job, and definitely the first time you started saving money, I need to accumulate. But that changes when you're in retirement. It's now about the income side of things. So the growth is important, right? We want to grow our money at least to what our withdrawal rate is. We need, if we're taking 6% out, we want our portfolio to grow at least 6%. And that's not even counting for inflation. But volatility is my next point under the paycheck replacement. Let me promise you this, and I can't say promise very much on the radio, but I can promise you this. You will feel volatility significantly more when you are retired than when you are working. I hear it all the time. It's like, oh yeah, I didn't care about, 2008, 2009 dot-com bubble burst. I was working. I was still putting money in my 401k. I was buying at a lower cost. Everything was fine. Ask that to a retiree who has a fixed income coming in. Well, I'll tell you, they feel those market declines, even small ones, 5, 10%. They feel them. So just know that when you go into retirement, you, again, will feel volatility. Even though you're in the income phase, you will feel volatility. And those are some of the questions you have to answer to yourself when you and your advisor, or if it's us, when we sit down with you and say, okay, really, how do you feel about it? I mean, what would happen? What would happen if your portfolio dropped 5%, 10%, 20%, that type of thing? That really helps in the allocation. The more honest you can be with yourself and with your advisor, the better off you're going to be. All right, when we come back, we'll talk about layering income sources as we begin to wrap up our topic. Once again, the retirement income gap, why most plans fail in the first 5 years. Let's wrap it up with Kristen Snow, the Right Now Traffic Center. Hello, Kristen. Go back to the Jon Sanchez Show on Newstalk 780 KOH. Pleasure to be with you this snowy Wednesday afternoon. Again, the retirement income gap, why most plans fail in 5 years. I want to go back to my sequence of risk. I felt I didn't do a good job explaining this. I want to go back to this just real quick. Again, this is about the timing of when you go into the market. So I want to just clarify something, because again, I felt like I didn't do a good job. Essentially this, if you're invested in the let me try to rephrase this again. If you were invested in the S&P 500 and this sequence of risk affected you, right? So again, you started with $1 million. Your first year in 1989, you're up 31. The market gained 31.96%, so on and so forth. If you follow that sequence of risk, again, that $1 million portfolio would be worth about $580,000, taking out your $50,000 a year, and again, 3% inflation. So I didn't, like I said, I apologize. I didn't do a good job explaining that. So million turns in about 580 from, again, the time period of up to about 1989 to 2008, where again, if sequence of risk did not apply, double to triple that amount. So again, I apologize. If you want clarification, just by all means reach out to me. So just wanted to, once again, go over that with you. So once again, do apologize. All right, let's go to layering income sources. This is another important thing. I touched on this briefly a few minutes ago. So when we talk about layering income sources, the worst thing, and I say it all the time, The worst thing that a person can do is rely solely upon their portfolio income, right? And I'm talking about, all right, I did a great job. I'm proud of myself. I saved a couple $1,000,000 of my IRAs. Everything is great. I'm going to take out my 5-6%, whatever the number is. Biggest mistake you can ever make, because you're not layering your income sources. The old adage, all your eggs are in one basket. Once again, let's go back to some of the historical downturns in the market. Can your portfolio substantiate that and sustain that? And the answer is you may, depending on how much you have, but it may not. Wouldn't you rather have sources coming in? This is back to the risk that I mentioned a moment ago, which again is the Social Security, the guaranteed or predictable income sources. Investments, again, usually it's going to be the stock market that keep you ahead of inflation. So you see, asset allocation is even more important in retirement than when we're working, in my opinion. Why is that? Pretty simple. Because again, you need predictable income coming in when you're in retirement. When you're working, you don't. You got a paycheck coming in. Inflation protection, you usually don't feel inflation as much when you're working as you do when you retire, when you're on a fixed income. And the other thing too is you're not collecting Social Security usually when you're working. You wait until you retire. So layer those sources, diversify the portfolio. Don't rely solely upon the stock market to provide your income sources. That's the biggest point I want to make on that one. My sixth point is the stress test, right? We need to stress test the portfolio before we go into retirement. Or if we are in retirement, let's stress test it again. What happens again if the markets drop early, that sequence of risk? What happens if you live longer than expected? Right? We have clients that are living into their 90s now. When I started this business, very unusual for that. I mean, a man living into his early 80s and, back in the early 90s, that was about the norm. Now we're seeing, again, high 80s, low 90s. Money's got to last that long, right? But what about this one, stress testing the portfolio? What if retirement, medical costs go up, right? We know how much that is. You've heard us share the stories with clients that have gone into that didn't get long-term care, that have to go into long-term care facilities, or when one spouse has to go into long-term care facilities and the other one doesn't, right? The other one's left with still maybe making a mortgage payment or definitely keeping up with one house, all the utilities, property taxes, et cetera. And then the other spouse is sitting in an assisted living facility. Now that's double the cost. So what happens? Is that factored in? If not, it should be. And that's part of the stress test when you're in retirement. And why set it and forget it does not work in our opinion. Number one, retirement is not a one-time event. Income plans are living, breathing documents, just like I say with estate plans. They must adapt over time. They must change as market conditions change. They must change as economic conditions change. They must change as your life changes. Again, the day you retired may not be working going forward. And that's where you need an advisor like ourselves that are actively involved, right? We're constantly making changes to clients' portfolios and allocations and things based upon what's going on in their lives, what's going on in the market, and so on and so forth. So I'm going to leave you with this. If you are within 5 years of retirement, or again, as I've said, maybe you're already retired, you need an income stress test, not just a portfolio review. Give our office a call, visit our website, SanchezGaunt.com, and schedule a complimentary retirement income stress test. We'll show you where the gaps are, how to close them before they become permanent gaps, like that story I shared with you at the beginning of the show. Those poor people could never recover because they were taking out too much and there are too many losses in the portfolio. It can all happen. No cost, no obligation. We just want to give you some clarity in your life. Thanks so much for joining me. I do appreciate it. Don't forget, you can watch this on YouTube and listen to it on Spotify, iTunes, so on and so forth. Wherever you are, we'll hopefully be there in your pocket or on your screen. God bless. Have a great afternoon. We'll see you tomorrow on the Jon Sanchez Show. Take care.
Jon Sanchez is a registered investment advisor, and the opinions expressed by Sanchez Gaunt Capital Management, LLC on this show are their own and do not reflect the opinions of News Talk 780 or its parent company, Cumulus Media. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.